Hey everybody, welcome to Trading Capital's exclusive analysis. In today's video, we're going to be discussing the three major indices, starting with the S&P 500, then we're moving to the NDX, the Nasdaq, and then finally touching base on the Russell and where the clear relative strength, relative weakness, and overall comparison is in terms of if capital is rotating to tech, more of healthcare, more banks, or just simply chasing more of these indices higher. So starting with the SPX here, there's one common trend that I want you to keep in mind. This is the COVID trend line, connecting your major COVID low crash to your big pivot bounce in June, summer of June 2022, and then connecting through all of this chop and intersection. Notice how on the S&P, the SPX here, you've retraced back to that zone again and been rejected. And that zone just so happens to coincide with a major orange trend line moving average over here. This orange moving average is the 1 year moving average of this indice. It accounts for 365 days of data. And notice how we hit it over here as resistance. We hit it over here as support and yielded a massive bounce. But we tagged as resistance here, sold off. Just kissed it over here, couldn't get through, sold off, and now we're fighting that area again. It's clear that the 1 year moving average is sloping down, which means that this market is still technically in a bear trend, a much larger bear trend, even if you have the shorter term moving daily moving averages moving in an uptrend. So that on the daily chart is going to be the level to beat. I highly recommend paying attention to this key 365-day moving average, because not only on the S&P 500 has it kept you in check, if you look at the NDX, look at the level we're fighting now. The exact same 365-day moving average, we are hitting it yet again. And this is just showing you the clear relative strength in the overall Nasdaq. Also, if you look at the trend line, this COVID trend over here, major pivot low in March, major bounce level in June, we're well above that key trend line, which is clearly showing you that most of the money has rotated into a lot of the mega cap tech, and that's clearly where the overall strength lies. But now you have to factor in that with the recent rise in tech, and yes, it is showing better relative strength over the S&P 500, does it make the fact that now these mega cap companies' valuations are much more of a premium and make them more expensive on a fundamental basis? It absolutely does. And then when you compare where interest rates still are, these valuations of some of these important mega cap companies are just astronomically higher, and some of them on a fundamental basis are even more expensive than when the indices were trading near the all-time highs. So definitely pay attention to the 365-day moving average, because I think the Nasdaq is actually looking very vulnerable to seeing a little bit of a pullback. I could see us retracing and piercing this COVID trend line, basically coming back to the 12,500 level, give or take, and then you should yield a little bit of a bounce. But this orange trend line is now sloping down in pretty vicious alignment, and if you can establish consolidation above that zone, you're likely going to have to see a bigger pullback to the downside. Looking at the IWM here, obviously there's tremendous amount of relative weakness. Look how far below the overall trend of this COVID trend line you're trading below. So a clear resistance lies much higher, but notice how you're well below the 365 1-year moving average, and you're also below this blue 200 daily moving average. This pattern is setting up for a much larger move down, and you really still haven't fulfilled the downside target that I have in mind. But now what we have to pay attention to on the Russell, the IWM, which is honestly more of the larger barometer of the overall economy, because it's taking into account 2,000 stocks as opposed to the S&P 500 and the Nasdaq only 100. So what I'm paying attention to here now is we have this left shoulder rounding rotation. We have a clear standout head. Are we getting another right shoulder forming down? Now, head and shoulders patterns are only entertained if you break this neckline over here. If we break this trend line, I mean, it's showing that the Russell is very vulnerable, and a move down to about the 133s, 134s could transpire. Of course, you may get pivot bounces before that, but we just have to be mindful that there's a lot of bearish price action that is occurring in the overall Russell. And this is the question: if, let's say, the Nasdaq, the NDX, starts to see capital rotation out in a pullback, the big question is, do we see that capital rotate into some of the more beaten down names in the Russell? Or is it just a pure exit liquidity out of the market that transpires? So a lot of moving parts. It's going to be very, very interesting to see how the S&P, the SPX, can establish itself above this key trend line, and if it can inevitably retrace and recapture the overall COVID trend from your major pivot low in March. Those are just some little nuances, but just keep in mind I am seeing capital rotation distribution in a lot of the tech names, which may drag the overall indices down. On the daily chart of the SPX, there's still a mini inverse head and shoulders. I've never liked this right shoulder, so maybe there's a potential that the upside target doesn't fully play out. But nevertheless, this on the larger term weekly chart over here, you can see you're starting to get a weekly doji over here. That's signifying on a weekly basis there's distribution occurring at the highs over here. And notice, I put this level on the SPX in one of our earlier videos. This is a wall. This 4162 is just a wall of resistance because this was your big reversal zone, your big multi-breakdown zone, your failed breakout zone, a failure over here. Now you're testing that area again, and that is the line in the sand for the bulls to establish. Basically, it coincides with that 1-year moving average, and it's a massive, massive technical resistance level that you have to respect at this point. And just be mindful that any little pullback potentially into support could be a little bit of a buying opportunity, but my overall grand picture, especially if a recession takes hold in the later half of the year, and arguably even I think it could happen this quarter, we may see this market take out the, or at least challenge the lows. Taking out the lows is going to be very, very difficult because there are a lot of buyers there, but I don't believe we've seen a real capitulation bottom in the overall indices, which is why I'm still skeptical about the overall larger trend and potentially heading lower in the charts. Although I'm not afraid to buy technical levels on the long side, certainly if they retrace in the correct manner and pattern into support. For instance, if we got a retrace back to the neckline of this little inverse head and shoulder that just so happened to coincide with the daily 200 in a nice move down, that might be a potential long level to play a quick technical trade bounce. So definitely be paying attention because this market isn't going down in a straight line. Lots of volatility, lots of opportunities both on the long and the short side. Thank you all for tuning in. Please have a fantastic week and definitely stay tuned for our weekly sector review that we will be releasing sometime this weekend.